This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. Are we having fun here in 2026? I am, because value stocks are back in. And some of the stocks we've talked about over the last 10 years have taken off, but many of them remain cheap. I'm still trying to dig in and find as many of them as I can for you. So I'm running some screens again, and this week I'm running one that's on the PEG. We've run this one many times, the PEG ratio, which is the PE divided by growth. It gets us both value and the growth side. And right now, I still do want that growth side, right? Why not? I like to be greedy if I can. I don't want just cheap. I want the growth. And a lot of the value stocks and companies are in the growth category now because they're the old economy mostly. They're the forgotten ones, the old guard. But surprisingly, the AI revolution is now encompassing many of the old guard because someone has to go build the data centers. They are cooling the data centers. So you have these old companies that have been cooling for forever. They are transporting goods to the data centers or to have them be built. They're just in utilities. That's old school, right? It can't be any more boring than utilities and power. But these are all areas taking off in high demand. We now know that over $700 billion is supposedly going to be spent by the big companies this year on AI infrastructure and just AI, building it out. And there's no questions it's being built out. If we'll get all 700 billion, no one knows. But a lot of the companies, they don't need 700 billion. They need 1, 2, 3 billion. They're fine with that. They're fine with just getting their little cut of the pie. And these stocks are still cheap, even though many have seen big runs. But I didn't know what I would get when I ran the PEG ratio screen. I didn't think I would get AI infrastructure stocks necessarily because the PEG ratio on the screen is looking for 1 and under, and that usually indicates the value and the growth, but that is very low. And a lot of the AI infrastructure stocks, they have taken off. They do have the growth side. Their earnings are growing, but it's not really keeping up with what the stock is doing. So even on the cheaper ones that I've seen, I still see a PEG over 1 at like 1.3, 1.5. That's still cheap. But on this particular screen, it's not going to get them. It's not going to show up because I'm looking for 1 and under. So this is even cheaper than that. So I was curious what kind of stocks I would get in this PEG ratio screen. Now, remember, it does look for 1 and under on the PEG, and it looks for Zacks number 1, strong buys, and number 2 buys. And right now we're in earnings season as I record this on February 11th, 2026. So a lot of changes going on with the Zacks ranks. So hopefully I'm getting some companies that have reported recently, and we're getting some new information. And then it does look at current average broker recommendations on this screen too. So with just those things involved, I ran the screen and we got 20 matches. What was in this? Well, it's similar to a lot of the other value screens I've been running, not even the PEG ones. The deep value or the classic value screen had a lot of these same stocks. And these stocks are a lot of the foreign companies. They have run. They had big rallies last year in 2025, a lot of the foreign stocks. But they were so cheap over the last decade, and certainly last year, at the start of last year, that they remain dirt cheap even today. So they still have low pegs. But I do like the growth trajectory on a lot of these foreign companies. They have been written off. So don't be scared at some of these that are at new highs, because the other fundamentals are still there. So you should still be checking them out and looking at them. I know it's very difficult to buy a stock on its highs for many of us. Many of us value investors have troubles with this. Growth investors, not so much. They're like, it's at new highs. Of course I want to buy it because it'll keep going up. But for value investors, we tend to find a lot of value stocks after they've sold off, after everyone has abandoned them and they're at the 5-year lows. I've done a bunch of episodes on those. I just did one, the one that had like Whirlpool, Helen of Troy, all of those. Are they deals or traps? They're at the 5-year lows. That seems like a thing that value investors should be looking into. But value stocks hitting, new highs is rarer and seems not normal to us. But we should get used to it, because finally some of these industries and companies that were out in the shadows for years are now finally coming back into favor. Now, will this hold? That's the other question. We've seen mini rallies in some of these beaten down industries in the past, especially the banks. We had, several bank rallies over the last decade. And we even had a bank crisis where they sold off. They still haven't really broken out. Some have, especially the large cap like JP Morgan, Bank of America, those guys. But even on the communities and some of the regionals, they're still kind of stuck there, but they're cheap. So they're still values, but will those finally come out of it too? And some of the ones I'm going to talk about today, they're trading at the highs. Is there more upside in some of these? Or is it, a 2025 rally and then they're done? And then everybody's like, I'm bored. I'm going to go buy Microsoft again. We don't know. So this is one of the risks with buying these out of favor groups after they've already had like a significant rally. But as I said, they remain cheap. So another area that was in this list was gold miners. I don't think anyone should be surprised about that. I'm not going to talk about them. We're still waiting for several or many of them to report earnings. So we're going to see a lot of number ones and number twos this earnings season as they report earnings. And it's, holding over $5,000 an ounce for now on gold. That means 2026 earnings are going to be revised higher for most of the gold miners. And so those stocks are going to maintain their good Zacks rank, and they're still cheap. So I'm going to save those for another episode where I just focus on the gold miners. So what did I choose out of this list? I did go with the foreign companies because it's just too good right now. The story is too good. Some of these, one of them we've actually talked about numerous times in the past because it's remained cheap for the last decade. And it's not General Motors, but that is another one we've talked about over and over and over again. Finally, General Motors had a rally last year, and we'll see what happens with it this year. It's still dirt cheap too. But these are foreign companies, and you would probably know at least 2 out of the 3, I'm thinking. The third one I didn't know, and it looks like Zacks only recently got coverage on it because suddenly there is an analyst on it, and so we're getting the estimates in, and that's how we get the Zacks rank. So if nobody was covering it prior, it was just out there in the universe, but we wouldn't have discovered it with the Zacks rank. So let's dive right in and see what the stocks are this week. So I'm pretty excited. I'm excited to be talking about value that is performing this well. So the first one is Barclays. It is ticker B as in boy, C as in Charles, S as in Sam. Barclays, it is a mega bank in the UK. They are a leader in global finance. So they have many divisions. They have just like a regular UK division. They have UK corporate bank. They have private bank and wealth management. They have Barclays Investment Bank. And they have Barclays U.S. Consumer Bank. So this is more akin to like a JP Morgan or Bank of America type of bank, with the investment banking arm and all that entails. So they have reported earnings, but it just happened. And so it was good. That's why we got the number 2. They did beat on the earnings. So they beat 1, 2, 3, 4, 5, 6, 7 quarters in a row now. That's the turnaround. And the stock went nowhere for years. In 2024, it started finally rising. Big gains last year. And then it's kind of stalled a little bit here in 26, maybe because people are like, how much higher can it go? So let's just see. Over the last year, Barclays up 72% over the last year. And so that's why, it's stalling a little bit. Year to date, it's up, but only 0.5. So it's just kind of sitting there, treading some water. If you can get it on like a pullback here, it could, it's going to be cheaper. How cheap is it? So this is a number 2. They have a peg of 0.4 because we looked for 1 and under. So that's very cheap. They have a PE of 9.2, but as we know with banks, it's really price to book. And as we know with the banks, again, the analysts always say buy with the price to book at 1 and sell at 2. And we've seen Bank of America, JP Morgan, those price to book ratios really start to creep up. In fact, I think JP Morgan is over 2 now. So you really probably shouldn't be buying JP Morgan now because it is expensive. But Barclays 0.88 is their price to book. So it's under 1. So that's cheap. It does pay a dividend. It's yielding 1.2% here in the U.S. They did say they plan to return greater than the 15 billion pounds of capital to shareholders. That's between 2026 and 2028 on dividends and buybacks. So a lot of banks are shareholder friendly. They are as well. I did think it was interesting. They have released consumer data recently, and they said that's because they see nearly 40% of the UK's credit and debit card transactions go through Barclays. So they're a good source of data. Who's eating out in restaurants? How many trips are people taking? What is the sentiment going with purchasing at the retail? Are they buying apparel? Apparently, streaming was very popular in the month of January, and people are staying at home. It's still winter, and it's dark and dreary out. So good use of their money is to buy those streaming services, and they're watching that. The Bridgerton just launched as well. I wonder if that's also a boost. They did also talk about Stranger Things and a couple other shows that are boosting the streaming purchases. So yeah, Barclays, it is again trading near that high, but it's still cheap. Now, what's happening on the earnings? So they grew earnings by 21% in 2025. By 2026, this year expected to be up 27.8% for a bank, 27.8. 2027, we now have 9.8. That's still very good growth for a bank. And so I still like this. Like I said, I like these foreign companies that remain dirt cheap even after this kind of rally. But if it's going to just kind of sit there because maybe people think it's run too far and I can get it on any kind of pullback, then it's a good time to dollar cost average into it. And you also get that little dividend. So that's Barclays, ticker BCS. Okay, number 2 is the one I don't think many of us have heard of, but it is Korea Electric Power. Now, when I saw this, I had assumed, it's a utility, because we have covered other Korean utilities before on this podcast. And it says Korea Electric Power. Of course, it's a utility. And it's even under the industry, utility electric power. But what they really do is the maintenance of power plants, including nuclear, renewable, and thermal. They have 66 domestic offices in Korea and 11 overseas offices. And right now in the overseas business, they are doing service contracts in nuclear for the UAE and Romania. They have thermal service contracts with India, Madagascar, Jordan, Uruguay, and South Africa. So it's not just Korea, it's worldwide, but their overseas is smaller amounts of the business. But you can imagine how much maintenance has to go on at any of these kinds of power plants. And now there's stress on the infrastructure globally because of the data centers and the big surge in the use of power, even electric vehicles, all of that. And we're having to replace a lot of the infrastructure in the power. So that's what they do. So we shouldn't be surprised that they're having a good time right now. So they're a number 2. And this one is not even just dirt cheap. I don't even know what you describe it, but nobody's buying it. And then the earnings are soaring. Now, this is the one where suddenly we did get one analyst covering it. So we have 2025 earnings expected to be up 143%. And then 2026, 27.8. So they clearly haven't reported earnings yet. It says around March 10th is when we're going to get that earnings report. So we'll have to see if 2025 really turns out to be that good. And then, if 2026 is going to look this good too. So Korea Electric Power is called KEPCO, KEPCO, in all of their filings and everything. So if you hear that term, it's the same company. So PEG ratio is 0.06. So it's almost at 0. Can you have a 0 PEG? I don't know. That's crazy. No, I guess you can't because you need a PE. But the PE here is 3.37. That's how low that is. Price to book 0.8. So that's cheap. It's not a bank, but that's dirt cheap. We look for 3 and under on the non-banks. And dividend, they do pay one. It says it's only 5 cents or 0.2%. So you're not really getting much with the dividend. Now, shares have taken off starting in 2025 as everybody, started getting into foreign companies. Before that, they were just trading in a narrow trading range, and now they have more than doubled. Let's see, over the last year, they're up 200% now over the last year. Year to date, they're up 27.9%. But why am I not concerned about, jumping in right here after this big surge is because look at how cheap it still is. I'm buying these earnings and this growth. And it's still, they're basically giving it away at this point still. So this is why it's exciting to be a value investor right now, especially as these foreign stocks come back into favor. A lot of these we've talked about over the years, and they never did anything, the actual shares, even though they remain cheap. But this is when you start to see, a change in the dynamics, and the market is discovering these now. Finally, it takes a lot of patience to own these true deep value stocks. And you certainly had to have some to own Korea Electric Power over the last 5 years, because other than the last year, these shares are up 94% over the 5-year stack, but they were up 200% just the last year. So really, you had nothing going on for the prior 4 years. And so keep that in mind. But I'm looking at a lot of these stocks and I'm pretty excited about them. So, cheapness Cheapness is where it's at with the underlying good fundamentals. Okay, the third stock is Deutsche Bank. This is one we definitely have talked about over the years. It showed up in many of my screens, and I'd be like, Deutsche Bank, because of the issues it had during the financial crisis, which is now 18 years ago now. So time to move on from the financial crisis, because Deutsche Bank has two. Ticker is D as in David, B as in boy. And they reported their full year 2025 and Q4 on January 29th. So we do have the earnings on this one. And net profit on the year doubled. Costs were reduced, and they had solid credit quality. That is always the key with any bank, obviously. The credit losses were down 7% to 1.7 billion euros is what they have. That's the provision for the credit losses. So they've had to lower their provision, which is a good sign. So they're not seeing as much danger going forward with the credit losses. The revenues were up 7%, and they expect to raise the dividend by 50% at the May board of directors meeting. And so right now they're paying $1.18 in the US, or yielding 3.1%. So already it's very good. And then they're going to raise it. So again, banks are pretty generous with what they're paying out. So for some reason, Zacks is showing a dividend of 0, but Yahoo Finance is telling me that it's $1.18 or 3.1%. So I'm not sure why we have the dividend, but sometimes on these foreign companies, if they only pay like once a year, it can get messed up in our system. So I'm going to check on that and find out why it's not showing a dividend. But we should be able to get that dividend, even though they're over in Germany. So how cheap is it? It's a number 2 as well. All of these are number 2s, it turns out. PE is at 9, but of course we care about price to book because it's a bank. 0.8 as well. So similar to Barclays, 0.8, very cheap on the price to book, below 1. So we do want to get it. PEG 0.3, and earnings for this year expected to be up 18.9%. And then 2027, 13.9. So this is very nice, solid double-digit earnings growth after they killed it in 2025 with earnings up 136% in 2025. So they really turned it around. And so things are looking good. All of these are large cap companies. Market cap on Deutsche Bank is 71 billion. Korea Electric Power is 27 billion, and Barclays is 90 billion. So these are all larger cap companies, which we do want if we're going to invest in companies that are overseas, because it is harder to find information about small caps, and especially those overseas. You don't have nearly as many people covering it on the analyst side, or even in the case of Korea Electric Power, we finally just got an analyst covering it. So you still may not have anybody covering it, and we may only get coverage on the full year numbers and not quarterly. But it does look like with Deutsche Bank, we do have some coverage quarterly as well. So, do some of these screens, look around, expand your horizons. If you can't find cheap AI infrastructure stocks, which I'm waiting to do an episode on those stocks again. I have done several over the last couple of years, but I'm waiting to do another one until we get more earnings reports in, and then we'll see how expensive they really are, if anything is cheap, or what are the cheapest out of those stocks, because I do think people should own some of the AI infrastructure stocks if at all possible. But other than those and the gold miners, which I'm going to cover, as I said, on a separate episode, these foreign stocks are really where it's at right now. I do like the other old economy type of stocks. Many of those have been running, and I've been desperately searching for some kind of value amongst some of those. But, once you have Caterpillar, for instance, Nothing says old economy more than them. And they are an AI infrastructure play now. They're at all-time highs, but they're just not cheap whatsoever. Forward PE is at 32 now with Caterpillar. PEG ratio of 1.8. That's not super expensive, but that's definitely not cheap. They are growing double digits on the earnings again. So we liking all of that. Nothing wrong with the story, but these have turned into more on the growth side. Price to sales is at 5. That's way too high for me to want to spend on Caterpillar. So unless you were in it a couple of years ago and you did get in it at a cheaper level, then I can't justify buying it at this level, even with the double-digit earnings growth going on. So, yeah, it's an interesting time right now, but I'm keeping my eyes peeled for a lot of these values. I'm also keeping an eye on energy. The stocks have been running, but the earnings are not. The earnings still look terrible. But as we know, Wall Street is looking 6 months ahead, and they are thinking that the earnings are going to turn around by the end of this year, 2026, into 2027. But the Zacks ranks are terrible. The earnings look terrible. The stocks are actually expensive because the earnings look terrible. But I do still like that area. It's not going to stay down for forever. So I'm keeping my eye peeled on that. And I'll probably do an episode next couple months on energy as well. But if you see pullbacks in some of these areas, then, that could be a buying opportunity with some of them. But there's a lot going on in value stocks. Hooray. We're finally in the spotlight. I know I've said this several times when I thought value stocks were coming back in, but even the banks, Barclays and Deutsche Bank at 5-year highs. So they've broken out. Even the banks are interesting right now. So definitely tune in. You don't want to miss a single Value Investor podcast going forward this year. And you can get us on YouTube. I know many of you just subscribe over there. You're also going to get the ETF Spotlight and any of our other podcasts other than Market Edge, because that's a video. But you're going to get a bunch of them if you just subscribe over there, and it'll notify you. Click the notification buttons so that you're notified when the new ones launch. And so you can get stock picks, ETF, everything else that we're going to be talking about across all of our podcasts over there. So you want to do that. And you can also get us on Apple, Spotify, Amazon Music, anywhere you can get the audio podcast. You can get us on Zacks.com. You can click on the podcast link and get all of our podcasts there and listen in as well. You can get us just about anywhere, but be sure you do. Let me recap the stocks we talked about. Barclays, the UK bank. UK may be down on its luck, but Barclays is not. Ticker BCS there. Korea Electric Power, maintenance of power plants, a key area, dirt cheap. Ticker K as in Korea. E as in Edward, P as in Paul, KEP. And then we had Deutsche Bank, ticker D as in David, B as in boy as our third stock. And I'll throw it in. I mentioned Caterpillar. It's too expensive for me, but you should look at it. And if you are a long-term holder, you're having a great time here in 2026 as it explodes higher. Ticker C as in Charles, ATCAT. And I'll be back next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.